Welcome to the Old Fashioned Real Estate Show. My name is Jeffrey Holt, and this
is Brian Leverage.
Indeed it is, Brian. Good job.
Yes.
All right, we have a fascinating topic today. We're going to talk about amortization, which is one of the most interesting topics in all of real estate.
It's super exciting to most people because they don't know what it is.
True.
Which is why we're doing this show.
Exactly correct, because we are an education platform.
Yeah.
All right, so we're going to get to that amortization right after this.
Welcome to the Old Fashioned Real Estate Show, where hosts Brian Leverage and Jeffrey Holst for our old fashioned real estate advice.
Welcome back. So, Brian, amortization. What is it and why do we care?
Well, I'll answer that in reverse. We care because it produces a lot of money for us.
True.
Yes.
All right, so before we get into that, actually, let's talk about the 4 ways that you make money in real estate. We're going to do this really quick because we've already made an episode about that, and that is above Brian's head. It's called The 4 Sources of Real Estate Returns. I think it was like our 4th or maybe 5th episode. It was before.
It was a while ago.
Yes, it was. It was a couple
We're
years ago.
still filming on a box, maybe.
No, I think it was after the box, but it was definitely after those first 3, which you guys should definitely not go back and watch because those were filmed really bad. But this was before we had a professional camera crew. Now we have a whole crew on the other side of the cameras. His name is Cameron. Cameron the crew.
Cameron cameras.
Yes, that's correct. Anyway, so the 4 sources of real estate returns are 1,
cash flow,
which is a measure of safety. 2,
amortization gains.
Yeah, that's a good one. That's the one we like. 3,
appreciation.
No, that's 4. I mean, it doesn't really matter the order. But if we want to do it in the same order we covered them before, it's tax advantages, which include things like cost segregation, which, you know what?
Past episode.
Yeah, we did do an episode, but you know what else? Let's just do a quick commercial.
Yeah.
And now a word from our sponsors. Who's sponsoring us today, Brian?
Well, we are, Jeff.
We are. How amazing. So we want to tell you about how you can save an enormous amount of money on your taxes and how Brian and I have been able to eliminate our taxes entirely.
You guys need to learn about cost segregation, which you can do by going to our website, oldfashionedtaxsavings.com.
Yes, and if you go there and you fill out the form, you can get a free, no-cost benefit analysis that will show you how much money you can save and what it will take to do that. And now we're back. So now that you know everything you need to know about cost segregation, you can also look at things like 1031s and depreciation and things like that.
Yes.
So that is the tax advantages. And then the last one is appreciation, which we're going to save for next episode.
That's right.
All right. So now that we've covered the 4 sources of real estate returns, let's go back to amortization.
Yeah.
So fun fact, Brian, do you know what the root of amortization is?
Latin.
Correct.
And it means death.
That's right. The word mortis.
Yes.
Death. And the reason they call it death is because the mortgage, also rooted in mortis, dies after a period of time. In most cases, 30 years. But in commercial world, it might be 20 or 15 or 25.
Well, and back then, people's life expectancy was a lot lower. So they frankly probably went more hand in hand.
Yes. You lived 30 years and then you died along with your mortgage. But the point is, a mortgage pays itself off over time, and as that principal balance goes down, you are amortizing the
debt,
the remaining debt. So the point is, amortization is really just the pay down of debt over time.
Well, and the way it's calculated is the lender, regardless of the asset type, calculates the interest over the life of the loan, and they divide it by the total number of payments. And then in the beginning, your payments are skewed more towards interest.
Correct.
Which is especially true the longer the amortization period is, right? So
and the higher the interest rate, actually.
Yeah.
Well, actually, technically, the lower the interest rate, the more you pay towards interest on the front end because you're paying less interest over the life of the loan, so they don't have to pay as much off in principal. So basically, you've probably heard the term P&I, which is principal and interest. Your mortgage payment consists of both a portion that goes to pay down the debt and a portion that goes to cover the interest for that period, usually a 1-month period. The part that goes to pay down the debt goes up every single month because every month you owe a little bit less interest.
That's right.
Now, on a 30-year mortgage on like a $200,000 loan, that first month you're only going to pay off a few dollars. So the next month it's going to be like, instead of $2, it's like $2.01. It's just not very much of a difference. But over time, that accumulates, and then the amount that you pay off goes up.
Well, and that's where, sort of lenders will tell a lot of borrowers, especially on home loans, right, owner-occupied properties, if you do your payments every 2 weeks as opposed to once a month, you're essentially paying 13 times a year a full month's mortgage, which shortens your time span by about 7 years.
There's some really interesting stuff with this too. The other thing you could do is just pay a few dollars extra. At the beginning of the loan, one way you can look at it is that any dollar you pay is invested for the life of the loan at the interest rate. So if you have a mortgage that's, say, at like 3.5% or 4%, whatever it might be, and you pay $1 extra, it's like putting that money into a savings account that pays 4%. That's how much it's going to knock off the loan. So if there's 30 years left and you pay $1 extra over a 30-year period, that dollar is going to pay off an enormous amount on the back end. So what happens is if you pay even something like $10 or $15 more per month over the life of the loan, you can literally knock off years off of your loan just by paying a little bit more. And that's what you're talking about when you pay every 2 weeks, because two things happen then. One, you pay a couple extra payments a year, but also, one extra payment a year, because there are 26 2
But that goes towards your principal, and thus reduces the interest.
And also, because you're paying every 2 weeks, you're getting less interest because you're paying 2 weeks early on the loan. And this is also, by the way, why it's really important not to get those late fees into your mortgage, because if you pay late, the late fee gets eaten up, and then you're even further behind, and it takes longer, and you end up with a balance at the end of your mortgage, in some cases, depending on how your loan is amortized. So that's what amortization is in a general sense. But I want to talk a little bit about how you figure out an amortization table, because this is where people get lost. I mean, you can do it in Excel, but it's pretty difficult.
Cumbersome.
Yes, we've figured it out because we do this a lot, and we're weird.
By we, Jeff.
Correct. Yeah. Well, you know how to use the table I provide you, so there is that. But fortunately, it's not that difficult to figure out, because all you really need to do is go over to Google. And by the way, Google, if you want to sponsor our show, we're happy to take your money. And by the way, we'll be happy to throw in references to like McDonald's, Burger King,
Maker's Mark, Knob Creek.
Any of those if they want to sponsor our show. But if you go over to Google and you type in amortization schedule or amortization calculator, you're going to find something that will allow you to program in the variables. Unfortunately, it's really not that hard. All you really need to know is what the starting mortgage amount is, and what the term is, and what the interest rate is. You plug those three variables into one of these mortgage calculators. It'll spit out a table that'll show how much you're paying off each year. And this can be very significant. For example, I was recently looking at a $2 million purchase price on a building. If I bought that building with a 20-year loan, right? 20-year loan, 3.5% interest, which is kind of what the terms would look like, and I put 25% down, I would be paying off $50,000 a year. Now, not me, I'm not paying it off because my tenants are paying that off. And so this is one of the reasons why Brian and I love amortization. I guess I shouldn't speak for you. I assume you love amortization?
Mostly.
Because every single month, as our debts get paid down, we're getting a greater and greater amount of equity, which of course increases our net worth and is something that we can tap into in the future through a refinance or sale, which will allow us to continue to expand our real estate empires.
Yes.
Oh, and by the way, we did an episode on the difference between the return on investment and the return on equity, and you should definitely check that one out right there. Oh, or somewhere over there.
Somewhere.
It might be over here, actually. I'm not really sure, but somewhere in the world above our heads will be a link to that very episode. Oh, and if you're watching this on YouTube. If you're not watching it on YouTube, then you're just going to have to look it up. I don't remember the episode number, so I can't tell you what it was.
But it's one of the great parts about being a real estate investor. I think, simply put, right? Like it's not a topic that's easily understood by many people, investors included. But the point is, if you've got a property that is a rental property and you're getting an X amount of rent, and that rent covers the expenses and your debt service, even if you're not making anything after that, The point is that every single month you are gaining equity in that property by virtue of them paying down your mortgage for you.
And that doesn't even account for potential appreciation and cash flow. This is just one element of the returns that you get. And anyway, actually, here's a good example just to clarify this all for someone. What if you bought the house that was next door, across the street from you? Say it was a 30-year mortgage and you rented it out and you made nothing, like in your example, and you had a 30-year mortgage on it, and you just bought that today. And then you just let the person who rented it pay the mortgage payment, pay the taxes and insurance, and you just broke even for 30 years. How would your life look different 30 years from now?
Well, you'd have a $100,000 amortization gain.
Oh, yeah, assuming it was a $100,000 property.
Yeah, financed.
And you would have, but the point is, if rent stayed the same the whole time, expenses stayed the same, these are variables that are very unlikely, but if that were to happen at the end of that mortgage, when it's fully dead from the amortization, when it's been killed off.
You have to hope you aren't.
Yes, and you're still alive, hopefully. You'll have essentially whatever that mortgage payment is will now become cash flow to you. Mm-hmm. And of course, you could then sell the house and take the money and just go on vacation. You could live on the, say, $1,000 a month if it met the 1% rule, like the episode we did last time, right? You would be able to live on that. So anyway, I think that's about all I have on amortization. Brian,
I think that covers it. No, we're good.
Are you sure?
Really sure.
Okay, good, because if we go too far down this road, we might